The broadcast is now starting. All attendees are in listen-only mode.
Hello, good afternoon, and a very warm welcome back to the latest BKL webinar. It's been a while. I hope you're all well. Delighted to say today I'm joined by my old colleague, Geraint.
Hi there.
And making his debut today, the very lovely Andrew Levine.
Hi there.
And we're here to talk about the autumn budget for 2017. Even the name slightly confuses me these days because it used to be this would be the 2018 budget, but because it's been brought forward, it's now the 2017 budget, albeit we've only just had the last finance bill passed. So here we are with further legislative changes, but we'll delve into those, try and give you a tour of the salient points. Wasn't the most exciting budget in the world, dare I say. Colleagues, what did we think?
Not really.
Well, from a personal tax perspective, I felt a little bit shortchanged to start with because there was so little personal tax work involved. But now I just feel a sense of huge relief that I will not have to spend hours and hours reading vast amounts of tax legislation. So I'm quite happy, to be honest.
Okay, a giveaway budget? What do you think?
There were a lot of giveaways.
Yes, certainly giveaways. How they'll be paid for, well, only time will tell.
Okay, but as always, the devil's in the detail, isn't it? And we'll try and drill down into some of the more important change. And in particular, this is why Andrew's here today. I think that the area that probably got the least amount of initial attention, but where the most significant change is probably in property tax. So we will be devoting a significant part of our time today looking at that, albeit even I think we would struggle to fill a whole hour with this, so hopefully we'll have you off for your sandwiches a little bit early today. Okay, as always, do feel free to type in with your questions. We'll do our best to answer those either as we go along, or if they're really difficult, we might send you a separate reply. But we do invite and welcome your comments, so feel free to type away in the box, and we will do our best to respond. So let's get on with it then. So we're going to start by looking at some of the business tax changes. That's me. And in particular, the changes on EIS and VCTs. It's primarily from an EIS perspective that we see these changes on a day-to-day basis. What were the key points there? Well, it's interesting that the Chancellor very much tried to target his EIS and VCT reliefs. And indeed, all the talk was about so-called knowledge-intensive companies. What do we mean by knowledge-intensive companies? Well, these are companies that invest heavily in R&D. There's certain tests about the percentage of their expenditure they must devote to R&D and related costs. And similarly, in order to be a knowledge-intensive company, you must meet the so-called either the innovation condition, i.e. you're developing IP to be exploited, or employed skilled employees, whatever that means, people with lots of clever letters and numbers after their names, etc., etc. So these changes are all about trying to encourage investment into so-called knowledge-intensive companies. And although, I'd say we don't do politics here, I think this is all part of the post-Brexit vision of Britain, where we won't just be wholly dependent on the financial services sector, but we will continue to develop cutting-edge technologies. So if you are lucky enough to invest in a knowledge-intensive company, what does all this mean for you? Well, at the moment, you can invest up to £1 million per annum in EIS, albeit there are carryback rules. That limit is raised for £2 million per annum, so long as at least £1 million is invested in our beloved knowledge-intensive companies. And if you are investing in a knowledge-intensive company, there are also limits as to how much money the company can raise. It can raise up to £10 million a year, raised from the previous £5 million limit. So targeted, more complexity, but I think we would all agree, good news. Now, EIS, VCTs are all part of sort of risk finance investments as described. We've also got seed EIS, various other investments that all count towards a lifetime limit. The lifetime limit of knowledge-intensive companies is now 20 million. For non-knowledge intensive companies, the most it can raise under these risk finance investments is still 12 minutes. And a few minor changes. Previously, or currently I should say, this limit excludes certain investments made before the 6th of April 2012. Going forward, that limit will include all risk finance investments whenever made. I have to say, we mention it for completeness, but I can't see that that is going to make too much difference to our clients on a day-to-day basis. So that's that. Here's the other big change on EIS, and I suppose we say also CDIS, it will affect, and VCTs, the risk to capital condition. What's all this about? Well, what the Chancellor wants to do is to encourage you to put your money where your mouth is, as it were, and to invest in so-called high-risk businesses. What the Chancellor doesn't want to see is people only putting their money in for the, albeit very generous, tax breaks that EIS, CDIS and the VCT regimes can provide. So we're now going to have some horribly subjective legislation that will exclude from those regimes companies who are only intended to provide capital preservation. So companies won't qualify unless there's significant risk of loss of capital, and the amount of loss could be greater than the net investment return, i.e. even after taking into account your income tax reliefs that you will get under these investment schemes. So are you making investment into genuine entrepreneurial businesses, or are you only doing this to provide a very nice little tax shelter? Now, the revenue say, of course, in their own lovely, comfortable way, will look at this in a reasonable manner. I suspect their definition of what's reasonable is going to be somewhat different to ours. But these rules are going to come into effect, and I think make life a little bit more difficult for us, insofar as we can never now be absolutely definitive with companies as to whether or not they will get this relief. I think we would know whether most of our clients are genuinely high risk, but there may be a number of grey areas here. We will have to see how the advance assurance mechanism works going forward. So those are the main changes on EIS. Some specific changes on VCTs. I have to admit we don't see an awful lot of these, but there are measures to expand upon what we've previously seen, again to encourage investment into higher risk investments. So a couple of mechanical changes to the way the legislation works there. The proportion of your VCT funds which must be held in so-called qualifying investments goes up from 70 to 80%, and 30% of the funds raised in an accounting period must be invested in such qualifying investments within 12 months from the end of the accounting period. But there have been a few minor relaxations that perhaps we'll save for another day. So EIS, VCT, hugely complex areas, only getting more complicated. Again, this is all about the Chancellor wanting us to target investment into high-risk industries. And it's interesting, in the past he had done this by challenging those industries which he felt were not high risk. For example, electricity companies no longer qualify for EIS. There are various industries that have been excluded over recent years. He's taken a slightly different approach now with these rules on the level of risk, etc., which can apply in those circumstances. So that's EIS and VCT. Anything to add, learned colleagues? No, they're looking very blankly at me there, I'm afraid. So let's move on then. Let's talk about business tax, and this is going to be a very short section, I'm afraid. Well, I say afraid, as Grant's alluded to, Geraint even. I'll get your name right one of these days. Sometimes less is more. Very few changes here. I think that's good news. There's been a huge plethora of technical changes over the recent years, which we struggled to keep up with, and we've had more than one Finance Act, etc., etc. So what did the Chancellor do? Well, we remain with a 19% corporation tax rate, and that's dropping, as we already knew, to 17% by 2020. Cap allowances, no changes there. The Chancellor's been eking away at those reliefs in previous periods, reducing the rates. We've had the special rate pool, albeit we've now got the annual investment allowance that has settled down at £200,000 per annum. The one slightly bigger change we flag up, indexation allowance. Companies still benefit from indexation allowance, unlike individuals where it's been phased out as we had the introduction of entrepreneurs relief, which we'll come back to. And I think the point here was it was very easy just to sit on an asset for a number of years just to let the indexation allowance rack up. Now, it goes back an awful long way since indexation allowance was restricted so it couldn't create or augment a capital loss. But for all companies now, indexation allowance will be frozen from 31 December 2017. And I suppose while inflation is relatively low, that's not going to hurt too much. It will be interesting to see the impact of that should interest rates and inflation pick up rapidly in the post-Brexit period. We shall see. So that's all we need to say on that. A couple of other changes. Research and development, my old favourite. No changes to the regime for small and medium-sized companies. The effective rate of credit there for loss-making companies remains at about 33%. For large companies, though, or small companies that are thrown out of the regime into the large company regime, for example, if their expenditure is subsidised, then they can claim the research and development expenditure credit, the above-the-line credit, and the rate of that has increased somewhat modestly from 11 to 12%. Started at 10, so it is creeping up, albeit that credit is itself effectively taxable. The rate that increase takes effect from is from 1 January 2018, and also in line with the advance assurance regime we have for small companies. Now large companies will be allowed to seek clearance that their R&D qualifies for these reliefs. So that's all good news, and also the Chancellor announced they are going to fly the flag for R&D credits some more. I think we saw some statistics. There are still, I think, approximately 50% of businesses that aren't even aware they could qualify for R&D reliefs, never mind actually seek to claim the reliefs. I find that somewhat surprising, so do bang the drum, as it were. Any company that's doing something that involves some sort of scientific or technological advance, well worth taking a look, and we'd be very happy to assist you if you have any queries. So that's that. One relief that is going, and I suspect will not be mourned greatly at all, is disincorporation relief. That was introduced for 5 years initially to 31 March 2018 and is not going to be renewed, I suspect, because it was absolutely useless and no one ever used it. And if anyone has used it, feel free, send me a message now, prove me wrong, but it was absolutely pointless, quite frankly. The limits were so small, it was of no real benefit to anyone. So disincorporation relief, that has gone. So those are, quite surprisingly, the only major changes. As always, there have been some minor tweaks on anti-avoidance rules for businesses. I'll mention just a couple. I do not expect these to have any significant impact. Depreciatory transactions, what's all this about? So you're about to make a capital gain on the sale of shares in a subsidiary, which, to be honest, you have to try pretty hard to do now with a substantial shareholding exemption, but it can still apply if you're disposing of a non-trading company. You may seek to strip value out of that company by a so-called depreciatory transaction, paying out, for example, dividends in excess of the amount of the reserves at the time of acquisition. In the past, you only looked back 6 years to identify any depreciatory transactions. Now you can look back forever. So a minor change. How HMRC will police that, I don't know, and it is pretty rare anyhow that would be relevant. There have also been some tweaks on the corporate interest relief rules, the availability of double tax relief, where you have a foreign branch and the losses of that foreign branch have already been sideways relieved against overseas profits that aren't subject to UK corporation tax. Similarly, little tweaks on carried interest, some technical changes to the rules on gains on foreign branch incorporation, and one further tweak on the substantial shareholding exemption. We have finally had passed the rules that substantially expanded that relief. So now the key condition is that you are selling shares in a trading company, and we don't no longer have to look at the group and its trading status post-disposal. That's good news, and a couple of changes just to make sure all those rules are tickety-boo and work exactly as we would expect. So that's all we need to say on the anti-avoidance rules. Moving on, let's talk quickly about the changes to partnerships. There are apparently 10 million words in our tax code. We have the largest tax code in the world. When I started, those red books went to 2 volumes at a push. They're now up to, counting across my desk, is that 7, Andrew? Maybe 8?
Yeah, 7.
7, okay, plus VAT. Okay, so 7 books. Yes, plus the index. Lots. We have the largest tax code in the world, and quite remarkably, those books say absolutely very little about partnerships, don't they? We're still reliant on a statement of practice that's been around since, I think, the 80s as to how to handle capital gains tax in partnerships. It's not legislated anywhere. The government has acknowledged that the rules on partnerships are somewhat vague. There was a previous consultation where what they said is what we would do is make some changes, not really to change how partnerships are taxed, but just to clarify how those rules work in practice. For example, the law at the moment says partnership profits must be allocated for tax purposes between members in accordance with the firm's profit-sharing arrangements in the period. And I think we all broadly know what that means, but I think HMRC's view is there has been some potential for mischief there, particularly where you have nested partnerships looking up or down. So you have a partner who's a partnership that's a member of a partnership, etc., etc. How do you look through that chain of partnerships going up or down? Are all those separate trades, etc., etc.? So HMRC, further to the consultation, have tightened up a little bit there, although it shouldn't make significant difference again to our day-to-day work. But just to give you one practical example of the sort of thing they're driving at here, let's say you're an accountancy practice. Let's say you have some hard-working fixed salary partners on a very modest salary of, well, £50,000 a year, let's say. We wish, hey. Now, there's always going to be the normal tax adjustments in that partnership tax return, adding back the copious amounts of entertaining that partnership does, deducting capital allowances, etc., etc., etc. Now, the question is, if you're on a fixed profit share of £50,000 in my example, is your taxable share of that profit £50,000, being that's what you get, or do you say, well, that £50,000 has to take its proportion of those add-backs and deductions? And it's never been entirely clear. Certainly going forward, though, HMRC's view is that even a fixed salary partner, his profit share has to be tax adjusted. So that has been clarified, and I suspect will mean that certain fixed partners will end up paying a little bit more tax. That is the way the cookie crumbles. So a few changes there. That will take effect, I think, for accounting periods starting from 1 April next year. So no significant change, but it will impact, as I say, particularly on salaried partners. No further changes to the salaried partner rules or the mixed partnership rules that came into effect in 2013 and have had a significant impact. Let me just talk also about a couple of consultations before I hand over to my learned colleagues. Entrepreneurs Relief, best deal in town, quite frankly, from a tax perspective. As we all know, 10% rate of tax for capital gains tax purposes on the disposal of a trading business, an interest in a trading partnership, or shares in a trading company. And in theory, conditions not too complicated. You've got to own 5% of the ordinary share capital. Those shares must give you 5% of the voting rights, and you must have been an officer or employee throughout the previous 12 months. That's all well and good, nice and simple, but what about the situation where you've invested in the company and the company needs to raise more equity? That could dilute you down below 5%, albeit what is being done is purely for commercial reasons. And HMRC have acknowledged in those circumstances that's a little bit harsh, as they say. So there's a consultation in spring 2018 where they'll look at if and how that point can be addressed. And let's hope it is, because we've certainly seen it in practice that can be a real issue for companies who do indeed need to raise extra equity but don't wish to prejudice their minority shareholders. I would just add for completeness, the other best deal in town, as it were, from a tax perspective that we see are shares acquired under the so-called EMI scheme. Now, if you're lucky enough to acquire shares under those arrangements, you don't need to meet the 5% test. So those shareholders, notwithstanding they don't have the 5%, even if they're diluted down further, should still benefit from a 10% rate of CGT. So we'll await the outcome of that consultation. We'll keep you posted. One final point, a further consultation. HMRC are looking to expand the circumstance in which royalty payments to Johnny Foreigner are liable to income tax. And although we have very few details here, this is targeted, we believe, at payments to low tax jurisdictions, in respect of sales to UK customers. Now again, as I say, consultation not expected to have effect from 1 April 2019. I suppose not a huge surprise given the direction of travel with regard to BEPS, etc., etc. And as Andrew's going to see and explain to us further, certainly when it comes to raising more tax, the Chancellor is looking at overseas individuals rather than just to his UK tax base. So we'll have to see how that one follows. Our pre-budget tip was to see some sort of dividend withholding tax introduced. That hasn't happened, but watch this space. As I say, I think the pressure is going to continue to be put on overseas people or individuals who have interests in the UK but aren't, it is perceived, paying their full share of tax. So those are the main business tax changes, aside from, I think, the key, where I'll now hand over to Andrew, who's our property tax expert, where, although in the budget statement it wasn't really highlighted, I think this is the key area that could have a significant impact on our clients. So Andrew's going to talk us through the property tax questions. As I say, any questions, do feel free to type them in and we'll do our best to answer those. Right, Andrew, over to you.
Thank you, Anthony. As Anthony's already said, this is all about non-residents and in particular capital gains tax. We've already got non-resident capital gains tax for non-resident, but at the moment it only applies to disposals by non-residents of UK residential property. And the proposal is that from April 2019, that this is going to be extended firstly to UK commercial property, so I guess no great surprise there. But secondly, and more significantly, entities which derive their value from UK property. It's only a consultation at this stage, so it is possible some of the detail that I'm going to run through could change. Although having said that, I think it's quite clear in the conduct that the government isn't actually going to change its mind on the fundamental substance of the proposals.
Andrew, we said this is going to expand it to commercial property. At the moment, residential property, as we know, is within the charge to UK capital gains tax season for non-residents, but non-close companies have previously been excluded from that regime, haven't they? Are these rules going to change the position even where residential property held by non-residents was currently outside the regime?
Yeah, we're jumping ahead a bit, Anthony,
okay.
But we will come on to this. But very broadly, yes, everything is coming in,
okay.
With rather limited exceptions. So we'll go through the detail.
Okay, just getting overexcited there. Sorry, Andrew.
Okay. It's nice to have a question. So what do they mean by an entity deriving its value from properties? What they've told us, it means a company, a partnership or a trust, and it's also going to include an option or any other matter affecting UK land. So quite widely drafted. And an entity disposal is going to be within the charge if, firstly, 75% of the entity's value is derived from UK land, and secondly, the person selling the interest holds or held an interest of more than 25% in the entity at some point in the last 5 years. The 75% test is based on the gross value of the assets, and that means that you ignore liabilities. So you can't say, oh, I've got a property worth £1 million and it's got a mortgage of 900,000, so the net asset value is only 100,000. Now, what they look at is the million gross value of the land. And you also ignore non-UK land. That's not taken into account in the calculations. For groups, the 75% test is looked at on a group basis, and there's going to be rules explaining how you trace through value to lower entities in the group. The 25% test, not surprisingly, includes holdings by connected persons. And when you're looking at the 5-year period, it also includes periods before April 2019, even though the rules don't actually come in until April 2019.
This is, I mean, when we talk about valuation of properties, this opens up a whole can of worms as far as valuation, etc., etc. Disputes could be had with the revenue. It's going to be quite difficult to police this, isn't it? I mean, for some of our clients, it's going to be obvious, but where they're on the threshold, we're going to have to do valuations on an annual basis.
Yeah, I mean, absolutely. And as you say, I mean, for pure property investment companies, I think it's going to be pretty clear cut. But where you've got companies which hold a mixture of trading and other assets, then obviously, valuation could be quite tricky. One thing that they haven't specifically mentioned in the conduct is goodwill. And I'm assuming if you've got a trading business that you will be allowed to take the value of any goodwill into account, but it hasn't specifically said that. So I think we'll have to wait and see what the detail is.
Okay, thank you.
Okay, so how do we calculate the gain? Well, for direct property disposals, you're going to be allowed to use the April 2019 value as your base cost, or alternatively, if it gives you a better result, you can use the original cost. And this will be better if, by reference to the original cost, you've got an overall loss, but for some reason in April 2019, it was a lower value, which gives you an actual gain. So you can still use the original cost. For residential property only, you can continue to use the existing time apportionment basis, where you basically take the total gain and just split it between the pre and post April 2019 period. The government in the conduct says it wants all gains on commercial property that arose after April 2019 to be taxed. They don't say exactly why or why it should be a different rule for commercial to residential, but at the moment that's what it says. Just picking up on Anthony's point before, if you're already in the non-resident capital gains tax rules, possibly because you're a non-widely held closed company, then at the moment you're using 2015 or a 2013 base value if you're within ATED, those values will still apply. So you're not going to get a freebie uplift to the 2019 value. If you're already in it, then you're stuck with the original base values. For entity disposals, you're only allowed to use the April 2019 value as your base cost. And again, it's not really clear why that should be. Other rules, as far as possible, are going to be the same as existing rules. So companies are going to be in corporation tax, and that aligns quite nicely with the proposal to bring property investment companies, non-resident property investment companies, into corporation tax.
So just so we're clear here, Andrew, you're saying if we have a company with significant UK property assets that we sell, we're going to have to value that company at April 2019?
Correct.
That's going to be,
yeah,
well, open a few arguments with HMRC, isn't it?
Yeah, but as you say, this is it's all about valuation, and the fact that you don't seem to be able to use the time apportionment basis means that an apparently much simpler option just doesn't seem to be available.
And these are,
I suspect that something will come out in the consultation process on this.
Well, these could be, let's be honest, BVI companies who don't file accounts anywhere. On what basis are we going to agree a value with HMRC? And I know I'm not expecting you to be able to answer all these questions, but I can just see this is really going to open up a whole raft of unpleasant discussions in the future.
I mean, it's going to vary. A lot of the BVI companies we see will be just single property entities, and the value of the company will probably be just largely the value of the property, which is relatively straightforward.
Okay.
Still provides lots of scope for argument. So everybody else is going to be in the capital gains rules, and they've also said that existing exemptions are going to apply, and the conduct refers specifically to section 2711A of TCGA, which is a section which exempts non-UK pension funds from capital gains tax. So non-UK pension funds, like their UK counterpart, will be outside the scope of UK capital gains tax.
Okay, thank you.
All non-residents are going to be within the charge unless, as we've seen, there's a specific exemption. So there's no exemption for widely held funds. This is what Anthony was asking about before. The existing rules do exempt widely held funds. That is going to go. Property funds and collectives are also going to be in the rules in the same way as everybody else. So if you own some shares in a property fund, and you were to sell those shares, then if you're within the scope of the rules, then your sale will be subject to capital gains tax. And it's also this is also going to apply to, for example, to UK REITs. Currently, if a non-resident holds shares in a UK REIT, that's outside the scope of UK capital gains tax, but it is now coming in. Communal residential accommodation. The existing NRCGT rules include an exemption for certain communal residential accommodation, such as purpose-built student accommodation. The condoc is completely silent on this. It doesn't say that the exemption is going to be removed or it's going to stay. But I think we have to assume that it's going to go, because I think it would look very odd if every sort of property in the UK is within the rules, apart from purpose-built student accommodation and prisons. So my guess is it's going to go, but it doesn't specifically say. Similarly, non-domiciled taxpayers, most of the non-residents affected by all this are probably also going to be non-UK domiciled. And if a non-UK domiciled person sells a non-UK situs asset and keeps the money outside the UK, then in some cases the remittance basis can apply. So they haven't, again, the condoc is completely silent on all this, so we're going to have to wait and see what the interaction of these new rules and the remittance basis is going to be. But if they do allow the remittance basis, then that may be a way of deferring tax for non-domiciled individuals who don't bring the sale proceeds back into the UK. Interaction with Section 13 and other bits of the tax legislation. I mean, if you're already within Section 13 or some other anti-avoidance legislation about a gain which may crystallise in an offshore company or an offshore trust, that is not going to go away. But the existing non-resident capital gains tax provisions provides that you don't get hit twice. If you're within the non-resident capital gains tax, then that part of the gain is left out of Section 13 or the other anti-avoidance provisions. I think we have to assume that will be the same for the new tax. They've also said something about losses, and broadly the proposal is that any UK capital gains and losses, or gains and losses from UK property that a taxpayer has, can be offset against each other. And also groups of non-resident companies will be able to allocate losses between themselves in much the same way as a UK group can do. But one of the things that people asked me about all these offshore tax changes is how exactly is the government going to enforce them? So the first point is that the basic reporting is pretty much the same as the existing non-resident capital gains tax. You've got to do a special return within 30 days, basically telling HMRC you've sold something and how much you've sold it for. And then if you're in the self-assessment system, then you just do your normal self-assessment tax return and you pay the tax on the normal self-assessment date. But in addition, for entity sales, there's going to be a reporting obligation on advisors. And they haven't given us a definition of advisor, so it's difficult to say how widely this is going to be cast. But there will be a reporting obligation on advisors who are involved with the sale in circumstances where the advisor thinks it is possible that the non-resident himself has not reported the disposal to HMRC. The other thing that is not part of the conduct, but there is also a proposed register of beneficial owners of UK land. And the idea here is that the register will show who the ultimate owner of any piece of land in the UK is. And one of the things that they'll be able to see from this is when the ultimate owner of a piece of UK land changes. And if that ownership of that land changes without them seeing a corresponding tax return, then presumably they can raise an inquiry and just find out why. Double tax treaties. The conduct says that most of the UK's treaties reserve taxing rights on UK property to the UK, but it also says that a small number apparently don't. Some may just not allow UK tax at all. It may be reserved to the other country. I think the number of those must be very, very small indeed, because I've certainly never come across one. But some may allow tax on direct sales, but not on indirect sales. One thing to note here is there's also going to be an anti-forestalling rule, which basically says that if you try and do something before April 2019, to restructure the way your property is held so that you can get within the terms of a beneficial favourable tax treaty, then there's going to be rules to stop you doing that. Finally, just a word on ATED. ATED are the existing rules for properties owned by companies and occupied by the shareholders. very complicated, very overcomplicated, in fact. And the government says that they're going to look at abolishing or at least reforming ATED after April 2019. So hopefully there'll be more tax, but hopefully under a slightly simpler system. So, is corporate enveloping of UK property dead? The answer is not quite, but it is definitely on its last legs. Looking at the diagrams there, we've got a Mr. Chan who owns a UK residential property through two BVI companies, and on the right-hand side of the page, a UK commercial property through two BVI companies. So what can he still do? Well, the first thing is he can still sell the BVI companies without any stamp duty land tax, or without any stamp duty for that matter. Secondly, as I said before, the conduct was silent on the application of the remittance basis for non-domiciled individuals. So whether Mr. Chan will be able to sell the BVI company and claim remittance basis is something that we will have to wait and see. And probably the most important one on the right-hand side of the page for commercial property is that commercial property remains outside of Mr. Chan's estate for UK inheritance tax purposes. So that's probably the most valuable offshore UK tax benefit that is still left. I suppose the question will be for how long. So just talking about tax planning, as the government has helpfully suggested, it is worth looking at the double tax treaties. I suspect the vast majority of them are not going to help very much, but you may strike lucky and find that you are in a country where the double tax treaty either prevents the tax being applied at all, or possibly only allows it in respect of a direct sale as opposed to a sale of an entity. Just remember the anti-forestalling rule. If you do something before April 2019 to restructure something to get into the benefit of the treaty, that can be stopped. Double tax relief is probably going to be more important now than it has been in the past. If the investor is taxed in his own jurisdiction, then it's important to consider ways in which any UK tax that's paid on the gain might be credited against his own liability. And in some cases, you may find it's actually better to hold directly than through a tax haven, as may have been the case in the past. The decision whether to use the UK or non-UK companies, in some cases, I suspect there will be little or no advantage to using a non-UK company, and it may just be more convenient to use a UK company. Although just remember there is still this fairly significant benefit if you're holding commercial property, that can still be outside your estate for inheritance tax purposes if you use an offshore entity. So that's all on the non-resident changes. Anthony's already mentioned the abolition from January 18 of indexation allowances. Another change that's significant for residential properties, that from April 2020, the proposal is that capital gains tax is going to be payable within 30 days of the disposal.
Okay, Andrew, thank you for that tour around some quite significant changes on CGT. We will obviously have to wait and see how those rules evolve. There was, though, some good news on stamp duty, though, at least, wasn't there? Hurrah! Why don't you give us a very quick summary of those?
I'd say it was good news, fairly small beer, unfortunately, but yes, good news. There are new rates for first-time buyers. I've set the rates out on the slides. I'm not going to go through them. They apply on or after 22nd of November 2017. There's no relief at all if the price is more than $500,000, which means there could be distortion at the $500,000 mark. The other point to note is that these rates essentially only apply in England. They don't apply in Scotland at the moment because they have their own version of SDLT. In Wales, they'll apply till 1 April 2018, but then they're also moving to their own system.
What have you got to say about that, Mr. Jones?
Quite right too. Autonomy for the Welsh.
Okay. Andrew, thank you very much. Much appreciated. As we flagged up there, I think CGT is the one area, particularly where you have overseas investors, that particular thought might be needed planning going forward. Geraint is now going to move into the hot chair next to me and is going to talk us through the personal tax changes. Geraint is, please listeners, I'd point out, a little bit under the weather, but I've told him he can't go home sick until he's finished this webinar and done his timesheets. So be gentle on him. But Geraint, as I think you said before, no earth-shattering changes here, but can I leave you just to talk us through some of the more salient personal tax changes?
Well, good afternoon, everyone. As Tony and I have alluded, this will be a mercifully short review of personal tax, mainly because there was very little personal tax changes that happened. The usual slew of consultation papers were announced, and one was promised for 2018 on how to make the taxation of trusts, quote, simpler, fairer and more transparent. But I'm sure we'll all be waiting with bated breath for that one. But wait and see, and hopefully they can do something about decennial charges and things like that, which do make the whole thing rather complicated. Moving on, lifetime allowances. The government's announced that the CPI-linked increase to the lifetime allowance for pension purposes, if you recall, that's the total value your pension pot can reach, is going to go up from $1 million to $1,030,000. So
you may hear the popping of champagne corks in the background. Sorry, listeners.
We have very few people in the staff here who've got any chance of getting a pension pot to anywhere close to $1 million, I can assure you, and that includes the partners. Right, employees versus self-employed. This is an old chestnut that's been running and running and running, and it seems to never lose any momentum. You may recall a year or so ago, rules were brought in to stop the public sector from employing contractors who were in reality employees, and to avoid employers' NI. They could do this either by having them as self-employed or by using personal service companies. Well, the government have announced that they are going to issue a move to try to move that over to the private sector as well. So that will obviously put a lot of pressure on private sector organisations to make an assessment themselves as to whether they think someone should really be an employee. So I suspect most employers would rather err on the cautious here. Anyone who's been involved in this type of thing and lost the argument with the revenue will be well aware that 1 year with somebody's salary grossed up for PAYE and then rolled back for the previous 5 years, and then having penalties and interest added on top, it can all add up to a very, very large amount of money. So one's suspicion is that most employers in the private sector will err on the cautious here. Right, time limits for offshore non-compliance. This is yet another step in Inland Revenue's attempt to clamp down on naughty offshore and tax non-compliance. You've seen this happening more and more over the last few years. So this is a time limit change to assess instances of offshore non-compliance, and it is now going to be extended to at least 12 years in all cases, including where any omission or error was not deliberate as well. So that's going to leave people's situation potentially open for many years to come, even when there's absolutely no mischief being suggested or taking place at all. One does wonder about giving taxpayers the comfort of certainty that they can actually sleep easily in their beds on certain things. There's also an introduction of a requirement for designers of certain offshore structures, which could be used to evade tax, to notify HMRC of the structures and the clients using them. I'm sure we would very much like to see the small print on that, because that does seem to be a very open-ended introduction, and one does wonder exactly how broad a requirement of the planning here would be. I mean, there's plenty of planning around that would be regarded as being completely vanilla by most advisors, that hopefully would not be considered to be abusive or evasive in any way. Right. An interesting thing I saw, I'm not sure whether this came out in the budget or was just in some follow-up paperwork, but the Treasury has announced a proposed change to the tax penalties for late filing of your tax return. Now, those of you with long memories will remember that self-assessment came in 1996-97, and at that point then it was a £100 penalty if you missed the 31st of January tax filing deadline. Well, that fine hasn't actually changed since 1996-97, so we're now heading towards 2016-17 filing deadline, and it's £100 still. Now, that is due to change, apparently, and a driving licence style points system will be introduced. And fines will only become payable once 4 points have been accrued. Now, we're currently not aware of what will create a point penalty, whether it's going to be a late filing or a late payment, or generally that the revenue don't like you at all. We don't know, but this does seem to be an interesting development, and one does wonder exactly how this will develop. I mean, will we have kind of driving license style tax return awareness courses that we will have to attend in exchange for not receiving an extra point?
They could do the same for football as well, couldn't they? Instead of bookings, Mourinho and Wenger could go on a smiling awareness course or something like that. We digress. Sorry, where were we?
We were on tax return penalties, and yes, so I mean that's an interesting one. There was quite an interesting set of quotations from various the great and the good in the tax world, which ranged from "this is a really, really good idea" to "this is a really, really bad idea." So it seems that the court is still out on whether this will be welcomed. I think it'll all depend on exactly what a 1 point penalty will actually mean. Is it going to be a late payment? Is it just going to be a late filing? Is it going to be some more minor or more heinous infraction of the tax code? Right, benefits in kind. This is on the slide again. Once you'll see, finally a small concession on benefits in kind. Apparently, and I was unaware of this, that charging your electric car up at work was previously a benefit in kind, presumably based on the electricity charge that you were consuming.
What about charging your phone or your shaver? Does that count? Is that benefit?
Well, I'd have thought so, yes. I mean, my phone is on permanent charge at work, so hopefully no one from the Inland Revenue is listening to this.
Or Jeff.
Or Jeff, my managing partner. But going back to electricity provided by the employer in the workplace for charging electric or hybrid cars will, from the 1st of April 2018, no longer be a benefit in kind.
Hurrah.
Hurrah. I'm not aware we have anybody at work who has an electric car, but if they do, they'll be able to sleep easily in their bed tonight.
They're on their way. They just had to stop off to charge off the vehicle. So yeah. They'll be here shortly.
The only real benefit that we can see to this is that the amount of time and effort taken to calculate the tax charge probably far exceeded the actual tax at stake. So that's a little simplification. That was pretty much it for personal tax issues. Certain things were pre-announced and we all knew they were going to come in anyway. That kind of revolved around the non-dom charges. I don't want to run through all of those because they've been pretty much done to death in the professional press in the last couple of years. I will mention 3 points. One is a new rule to ensure that where benefit is provided to a close family member of a UK resident settlor, the benefit is taxable as if received by the settlor. Now, to give you a kind of example of this, you could have somebody who's excluded from benefit by a trust, and then the person who, somebody else does benefit and then immediately passes the fruits of that benefit onto person number one. We have seen circumstances where that happens, and we suspect that this might be angled at stopping that from happening. There's another interesting change. Trust distributions to a non-resident on or after the 6th of April will no longer be matched against the pool of trust gains. Now, those of you who aren't familiar with the taxation of offshore trusts will probably need a bit of explanation there. The current situation is that under Section 87, you have a pool of trust gains sitting within an offshore trust that get matched to benefits received by beneficiaries. Excuse me. Now, there's always been a little wheeze that one could pull whereby if you distributed the benefits, capital, use of trust assets to a non-resident person before a resident person, that had the effect of draining the Section 87 pool. So if you did it cleverly, you could distribute in such a way that non-resident people drained the pool and didn't get taxed because they were non-resident, and then anything after that got taxed on the UK resident person. But because there was nothing to match it with in the Section 87 pool, there was no tax. Well, that little avenue of pleasure is being shut off, and you will no longer be able to drain the Section 87 pool by distributions to non-resident individuals. So that's rather sad, unfortunately. If a beneficiary receives a trust distribution tax-free and then makes an onward gift to a UK resident, the UK resident is treated as if he has received a trusted distribution equal to the amount of the gift. That was the final one I wanted to highlight to you. But as you all are well aware, there's a great raft of changes to non-domiciles coming in from 6th of April 2018 and also 6th of April 2019. So this is an area we will have to pay particular attention to.
Okay, Geraint, thank you very much. Time to phone our PI insurers. I'll finish off by giving some VAT advice. There was a lot of talk about this pre-budget, wasn't there? The VAT limit might be significantly reduced, perhaps as low as £20,000 to sort of level the playing field between non-VAT and VAT-registered businesses. In the end, the Chancellor blinked. The VAT threshold is to remain at £85,000, is indeed to stay there until at least 2020, when in our wonderful post-Brexit world, we are led to believe, the position will be reviewed. So, no change there. A couple of anti-avoidance measures as well, particularly aimed at online marketplaces. From now on, the marketplaces can have joint and several liability with the businesses using their platform, and those businesses must clearly display their VAT number on the platform. I think we can all see what the potential mischief has been in the past there. Other consultation documents, in particular one aimed at the provision of labour in the construction sector, a sector that, as we all know, has been targeted in the past and perceived as an avenue of tax avoidance. It is intended there'll be a domestic reverse charge introduced from October 2019, so some time off, and as soon as we get more details then we'll circulate on Brass Tax or our website or a follow-up webinar. So that's all the changes we want to say on VAT. And that's that. That's the budget, ladies and gentlemen. Thank you for joining us. If you've got any further questions, there are contact details. Feel free to email us. You'll all get an email after this webinar saying thank you very much for joining us with a copy of the slides, a link to the presentation if hearing us once wasn't good enough. Otherwise, always welcome your comments and suggestions. If there's anything you'd like us to cover in the future, do drop us an email. Otherwise, thank you for joining us this lunchtime. We look forward to seeing you again soon. I did promise I'd do a webinar on leasing, didn't I? So maybe we'll cover that one next in the new year. For now, good luck with the self-assessment season. Have a good Christmas, a good new year. We look forward to you all joining us again in 2018. Thanks now. Bye-bye.
Bye.